Just take a minute here to introduce John O'Hare, who is our Economic Policy Director. John is a former senior economist with the Congressional Joint Committee on Taxation, and he played a central role in the design of our micro-simulation model, particularly with regard to the sales and excise tax portion of the model. And John's going to give you a very brief summary of the methodology underlying our report to give you an idea what we did to get these results.
Helping to put together a computer model for 50 different state tax systems, encompassing not only income taxes, but sales and excise taxes and property taxes, proved quite a challenge, to say the least. Not only did we want to construct a model that was similar in scope and sophistication to those models currently used by the Treasury Department and the Joint Committee on Taxation, but we also wanted to construct a model that would be useful for policymakers that are considering making changes to their tax laws. Let me just take a few brief moments to give you a glimpse at what lies behind some of the numbers that are in our report and that we'll be looking at today. The ITAP model belongs to a class of models, as do the models used by the Joint Committee on Taxation and the Treasury Department. They're referred to as micro-simulation models. The micro refers to the fact that the unit of analysis that we're looking at are individual taxpayers. This is in contrast to, say, a macro model that would look at large economic aggregates like the unemployment rate, inflation, productivity, and the deficit, things like that. Both models are, of course, related. Good macro models are founded in good theories of individual behavior. And micro models, if they're done right, should add up to give macroeconomic results. And that's what we were striving for in the ITAP model. The starting point for the ITAP model was a sample of close to 400,000 individual tax returns, federal tax returns, collected in such a way as to provide valid estimates at the state level for such items as wages, deductions, and federal tax liability. To this, we had to supplement this data with census information, so we had a broad representation of the population at each state. The sample was taken in such a way as each state's, to give valid statistical results at each state for these types of aggregates. This was necessary because the federal tax filing thresholds are different across states, and also even individuals in particular states that do not file tax returns do pay sales and excise taxes, and we needed to have them in our base to give an accurate representation of the burdens across states. The next step, once we constructed the database, was to age it to 1995 so we could look at one particular snapshot. And this was done, had to be done carefully to make sure that our aging procedure matched federal aggregates or national aggregates, and also population changes and shifts within each state. Once this was done, the first order of business was to take a look at the individual personal income taxes in each state. Since most states couple or link their taxes in some way to the federal level, this federal tax data was a natural starting point. And so we had to construct the tax law for each state, run it on each individual in that state, calculate the liability for 1995, and check this with published totals from the state revenue departments. Calculation of sales and excise taxes provided a somewhat different problem. Federal tax return data don't give us enough information on expenditure patterns to enable to infer what typical households would pay in state sales and excise taxes. And even then, it only tells part of the story. State sales and excise taxes are paid not only by residents of the state, but also by businesses located in the state, and by visitors who come to the state and spend money in hotels and restaurants. It was necessary to look at all three of these components for the sales and excise tax because the relative burdens on each one would say something important about the burden that's borne by the residents of a particular state. In order to do this, for residents of the state, we looked at expenditure patterns as contained in the Consumer Expenditure Survey, which is an annual survey done by the Bureau of Labor Statistics. It's the only information we have in this country on the expenditure patterns of households. We estimated relationships from this data and imputed this to households across every state, made state-by-state adjustments with certain items with respect to utilities, gasoline, and some other items of consumption to get our resident piece of consumption. On the business side, we constructed what economists call an input-output model for every state. We used a national input-output model, which arrayed about 100 different industries and the purchases that they make in producing their final output. We calibrated this to match every state's gross state product forecast through 1995. So we think we have a pretty good idea of the inputs that they would use in their production process. For tourism, we had data from the travel industry, which showed expenditures on broad categories of items in each state by tourists. Combining this into each state's tax law, we were able to sum the three pieces together to look at total tax collections for each state. We compared those with revenue figures for the latest year available for every state to make sure we were targeting the revenues correctly. For property taxes, we were able to utilize information from the federal tax returns for itemizers who itemized real estate and property taxes. And from our census data, we were able to obtain information on home values and property taxes paid. What we end up with is a comprehensive model of the major taxes imposed at the state and local level. The ITEP model is one of the largest of its kind in the world. I say one of, because I'm not aware of any tax model that's any larger. What we hope we've put together is a useful tool for policymakers when they consider in the next several years changes in their tax law.